And now, in a slight change to the programme, I'd like to invite up both Ian Johnson, who you've met already, co-founder of Idea Carbon and the Carbon Ratings Agency, and also Neil Eckert, who is an advisor to Idea Carbon and former chief executive of the Climate Exchange plc. They're going to share with us some insights into some potentially transformational products they're developing, focused on building institutional investor confidence in this space.
Me too. Thank you, Ingrid, and ladies and gentlemen. Welcome to this session. In many respects, finance is the critical issue. We have the technologies. If we had the political will, we'd have to match it with the finance. And I just want to spend a moment before I get into my talk really taking a rather sober assessment, I suspect, of where things are going, both in terms of energy mix, but also in finance. We're seeing coal use increasing fast, 600,000 tons per day, the largest increase in China, which is driving it at 30% above GDP growth. We are moving into an era of new and non-conventional oil that is crowding in financial resources, where financial costs of next-generation fracking are lowering, at the very time that the societal costs, whether it's to climate change or local environment, are increasing. It's a big challenge, but it is a space that is being occupied with incremental finance. Nuclear energy is quite uncertain for the future. We have 3 countries that have said they are getting out of nuclear energy. They represent about 10% of global nuclear energy. That will have to be filled with something. And we are beginning the process now of understanding that decommissioning costs of nuclear are going to be massive. And that's going to, again, be a drag on financial resources for the energy sector. We also have to recognize, as Ingrid said, that the financing needs of a capital-intensive sector like energy are enormous. IEA has estimated for some time now that you need about $1 trillion plus or minus per year capital investment, not recurrent, but capital investment, over the next 30 or 40 years, 30 trillion to the middle of the century. Recent studies suggest that climate finance to date is about 370 million, 270 of private, 100 of public. It is my view that the public sector finance over the next 5 to 10 years will not grow massively. It may grow, but it's not going to grow massively. Therefore, we have to look at the private sector. We have to look at private capital flows into new and clean energy. We have to decarbonize faster. The pressure is going to be on us to decarbonize faster than ever. And how we mobilize that money, I think, is going to be very, very important. I started my climate change career, as it were, at the World Bank, where I worked in setting up the Global Environment Facility, where we mobilized public resources to the tune of, over a number of years, of about 4 or 5 billion, and then moved into the World Bank, where I also oversaw our climate finance. When I left the World Bank, I met Nick Stern, who at that time was writing the Stern Review, and he introduced me to Idea Carbon and to Shandy, and suggested that there may be something that we could do to challenge ourselves on the big issue, how to unlock the private capital that appeared to put its toes in the water of climate change, but no more. What would it take? What we started doing was really rating of projects. I'm going to come on to that in a moment. Before I do, let me just, you will see in your black books, each of you have these black books on your desk. You will be able to go through these at your own leisure. But this really talks about how we set up, what our ideas were, which were, how can we make carbon an asset? How can we make investment in climate change no different from investment in other categories of investments that the private sector would be interested in? I think I have to do it this way. This again just talks about our organizations, Idea Carbon. Idea Global is our parent organization. there's some of the people involved, in particular, of course, you see Nick Stern and Shandy. Nick has really been a driving force in helping us think through some of the intellectual issues associated with climate change. This is our current and indeed one past team. Christiana Figueres was the vice president on our rating committee. She's now moved on to other things, as you may well know. She's now the executive secretary to the UN FCCC. But she was very instrumental in helping us think through ratings, and particularly programmatic ratings. That was an area she had. These are some of the companies we have served over the last few years, ranging from multilateral banks, large private multinationals, to the banking community as well. Again, all of this is in your folder. Some of the testimonials about what we've been trying to do and where we have made some success. This simply is a simple way of saying that the issues of standards are really a very common part of the financial makeup of the financial sector. They need standards for comparability. They need them to be able to force order, to rank order investments and potential investments. This is an example that shows the debt finance, the boom in debt finance that came from over the last number of years, which was driven in part by the kinds of measurement standards that I'm going to talk about, although these are custom tailored to the climate change and carbon markets. This is a rather complex way of us saying how we set up our project rating. We did it in two ways. We started by looking at small projects and analyzing those projects. We analyzed them from a number of different factors that we consider would provide the risk or risk analysis. Financial, of course, was one, and the extent to which finance was available. But when we were looking particularly at CDM, at developing countries, emerging economies, we also had to look at the overall framework within which those projects were operating. How was pricing policy? What sorts of questions were there about investment climate? We also had to look at the regulatory, at that time, the UN regulatory framework. So we assembled a risk profile on the basis of our project analysis here. But over time, and I'm going to come to it in a moment, we set out a statistical performance model on the basis both of our experience but also analyzing other databases. And I suspect today we have, as a result of that, one of the best databases on performance of energy projects that exist. As a detailed one and one that we draw upon. We then would meet in our rating committee. As I say, it included Christiana Figueres, myself, and several other independent judges of these projects. One thing that is very important, and I think it is to give the confidence to investors, is that you must have independence when you're looking at these investments. I worked at the Global Environment Facility, and we set up a science and technical panel that was to do much what we're asking here, was to rate or to analyze projects. The big problem is a renewable energy expert never saw a renewable energy project that he or she didn't like. And so it didn't help us in the independence, and that was something that was quite important for us. This demonstrates, in some sense, the last 5 years or so, how the business has changed and how the evolution of the climate investment business has changed. When we started, we were looking at very, very small, discrete projects. Frankly, they were almost suboptimal. They were so small. They were pioneering, some experimental, but very small. We then moved into the aggregation of small projects. We've moved from there to programs, and now under the UN you have programmatic CDM. And the next generation will be looking at the policy structures, the NAMAs and the like. And so we have seen a gradual progression from small projects to aggregative, to programs, to policies, and the mix of those. And as you move through that, you then need to look at different kinds of ratings, different kinds of benchmarks, different kinds of analysis. Another thing that happened is that it became quite obvious that we needed to not only look at carbon and carbon reduction, but also at energy efficiency in terms of kilowatt hours, for example, saved, etc. So we began building a set of tools that would both look at carbon savings, climate change impact savings, if you like, and energy efficiency. And these are listed here. I'm not going to go through all of them, but you can see that, that we have moved from narrow, discrete project ratings to something that is much more programmatic. And I think for the R20, the programmatic approach is absolutely pivotal. You will not get enough traction and the transaction costs will be too high on discrete small projects. They have to be aggregated. This simply says the same thing, that we are looking at energy efficiency returns and carbon returns, and then really trying to analyze the various ways in which that analysis, that rating of those projects, that rating of programs, we've rated portfolios, we've rated discrete projects, and we've rated programs under the CDM. I'll come on to that in a moment. We've also built up a fairly detailed statistical platform. Broad orders of magnitude, we have close to 150 projects, which is in great detail, that we've analyzed by technology, by country. From the RISO database, we have over 400 projects that we've analyzed, and we've looked at them in terms of performance, in terms of delivery, because at the end of the day, a financier is looking to see that the project will deliver what it says it will. And if you've ever worked in emerging economies, you know that you have to have a clear eye on the prize of implementation and delivery. And we've given that a lot of thought. We also have compiled and are able to make our own judgments, which are independent, but are backed by analytical tools that look at the 400 or so projects we've looked at. So we can analyze by technology, hydropower versus solar thermal. We can analyze by country, we can analyze by sector, and that gives us the comfort of understanding both the quality of investment, performance, and the performance risks and where they lie. And I think that's an essential building block if we are going to crowd in new finance, which is likely to be long-term institutional finance. This simply summarizes much of what I've said. We know that plenty of dollars are pledged, and I would just put a question mark about availability. I think those public sectors that have pledged money have often done it in rather strange ways by redirecting money that otherwise would have gone into the same sectors. So the extent to which some of this public money is really incremental is, I think, a challenge. Was something that the UNIDO DG Kenda did not mention, but I think the reality is that the funding pool is not as large as we would like it from the public sector. But we also are recognizing that debt markets may be a huge opportunity, and if they can be opened up, and if we can talk to institutional investors who are looking for longer returns and less interested in the higher short-term returns, if we can get them turned on by showing that quality portfolios, quality investments matter, we could actually drive money out of that financial sector and into the real economy and into the issues of climate change and climate adaptation, which is something will be needed. This simply really says the same thing, that if we can get independent risk assessments that are perceived to be valid, perceived to be credible, that can act as a catalyst for funding. And this can also help in trying to understand performance of energy efficiency and the like. And then this can be applied not only, in our view, to carbon and climate change, but also to other infrastructural assets that contain a public good, such as water resources and the like. We've begun to address some of the barriers on limiting climate finance, and we've built up a sort of expertise and a proven track record. Our technical person is someone who is a colleague of mine at the World Bank for many years, actually dealing with infrastructure finance. The ratings process, we've learnt a lot. And I have to say that things we thought were intuitively obvious to us at the beginning were less so. We had to build up a body of experience. We had to understand that in a developing country where much of the future demand, much of the future investment will be, you have to take a holistic view of the risks. You cannot just look at them as project risks and assume policy risks away, assume pricing risks away, assume the general environment within which the capacity to implement and to construct is mixed. So you have to look at a holistic view of these risks and come to a judgment that cuts right across from finance to regulatory to policy and sometimes to political. But we feel it is a useful tool. I mentioned earlier some of the examples. They are in your book, so I'm not going to spend a lot of time, and we may want to come back to some of them. But the issues of green bonds, discussed and mentioned this morning. Green bonds, any kind of bond issuance will require almost certainly a clear rating or an evaluation that is perceived to be high quality and independent. And I keep coming back to the word independent because in this business of renewable energy, climate change, etc., there are many, many advocates. And as I said earlier, my experience from getting independent advice from experts in some of these domains is that they were really advocates, not independent. They had a stake in the business. The sort of specialized funding vehicles for climate finance, we believe they can be leveraged up by a margin, a very high margin, if we have the right standards and metrics against which they can be measured. Covered bonds, another example where collateral is pledged to support and secure payments is another, and therefore reduce risk is another good example. Mark-to-market accounting, where we're looking at environmental asset valuation. We've done some of that work with some of the multinationals. And the one that is becoming a very big deal, certainly in the CDM market, is the programmatic analysis, or the program. Though we've analysed about 10 of them to date, I think, mainly in municipal lighting systems. That's been our main domain, and cook stove replacement, particularly in poor countries. There's a very wide difference between projects in poorer parts of the world, such as in Africa, compared with some of the more developed and countries that have relative strengths in capacity and have built up their own capacity. It varies enormously. So, So in summary, we've built products which directly address the challenges of scaling climate change. And we've looked at multilateral finance promoters, green bank initiators and the like. I think the institutional investors are still a pot of gold that is waiting to happen. And what we have to do to unlock it is to offer the kinds of standards, the comparability that can give them the comfort that they know what they're investing in. And I think that's an area where I suspect the R20 and ourselves can work together. So we're looking to work with those who want to promote climate finance. Our goal is to see precisely how to unlock the funds that are there waiting for long-term patient investment. They're particularly the institutional investors, probably not the banks at the moment, which are undergoing various strains through the global recession and through the re-regulation under Basel III. But we think the institutional investors are really a point to look at. I'm going to stop there, other than to say that our experience has been that by developing comparable standards and metrics that are trusted by the financial community, not just the climate change and energy and environmental community, but by the financial community, is really the cornerstone of us being able to unlock those funds. So I'm going to stop there and turn to Neil.